Retail investors look at Franco-Nevada, trading around $260 a share, and instantly scream that it's overvalued. They are completely missing the structural reality of the business. You are not buying a traditional gold miner. You are buying a financial counterparty that just posted a staggering 90.9% EBITDA margin for 2025. While every producer on the planet is getting crushed by supply chain inflation and massive sustaining capital blowouts, Franco-Nevada just delivered a record $1.82 billion in revenue without buying a single truck or building a single mill. Their gross is effectively their net. Let's run the institutional math. Wall Street analysts are currently valuing Franco-Nevada's net asset value at roughly $160 a share. Why? Because institutional banking models are notoriously slow. They build their net present value models using a conservative, long-term gold deck of around $2,000 an ounce. At a $260 share price, the market sees a 1.6 times price to NAV premium and calls it expensive. But let's run a spot NAV. If you plug today's actual spot price of $5,200 gold into that exact same model, the math gets violent. In a traditional mining model, if gold jumps from $2,000 to $5,200, labor, diesel, and steel eat a massive chunk of that gain. For Franco-Nevada, that equation is completely severed. Because they operate on a fixed-cost streaming model with a management expense ratio under 1%, 100% of that $3,200 delta drops straight to the bottom line as free cash flow. At $5,200 gold, Franco-Nevada's actual spot NAV explodes to roughly $460 per share. You aren't paying a premium. You are buying the highest margin streaming company in the world at a near 45% discount to its actual spot asset value. Next, look at the balance sheet mechanics. In a capital-intensive, cyclical industry, your ultimate competitive advantage is balance sheet flexibility. Franco-Nevada is entirely debt-free. They are sitting on $3.1 billion in available capital. They are generating so much free cash flow, they are mathematically forced to return it to shareholders, which is exactly why they just hiked their dividend by 16% for their 19th consecutive annual increase. Here is the contrarian reality the market is mispricing right now: the deployment of capital during distress. Over the last 24 months, while the broader market panicked over the suspension of the Cobre Panama mine, Franco-Nevada rode off the noise and went on the offensive. They aggressively deployed over $2 billion into new assets, acting as the ultimate alpha generators, buying peak cycle optionality using distress cycle leverage. Furthermore, the retail market has essentially valued their Cobre Panama stream at zero. But the Panamanian government is already showing a willingness to approve stockpile processing. Any positive movement toward a full restart is 100% unpriced optionality. It is pure, asymmetric upside. The verdict is simple. Franco-Nevada is the ultimate anti-earnings trap. The downside floor is violently protected by a debt-free balance sheet and locked-in stream prices. The upside is a free call option on global gold production and a massive exploration pipeline funded entirely by other people's money. It remains the premier vehicle for capturing the upside of a precious metals bull market, while completely isolating your portfolio from operational mining risk.